Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business.
Warren Buffett is no doubt one of the best investors of all time. He built his fortune by analyzing business and buying them at a discount. His investing strategy is one that can be described as one of wait, where he waits until he finds the right opportunity. Then he just go all in, and then once he do that, he then hold for years and decades upon decades to reap the benefits of his investments. He's known for great investments like Bank of America, Coca-Cola, American Express, and of late, Apple. And these companies have done excellent over the past years. One of the key things that led to his success more than his strategy is his temperament.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business.
Isn't this interesting that one of the world's best investors of all time is saying that you should not necessarily try and pick individual stocks like he do? This is important because one of the main reasons why individuals lose money in the stock market is not necessarily because they are bad stock pickers. Yes, they do pick individual stocks really well, but guess what happens? They lose money because of their emotions. They are buying stocks and selling stocks at the wrong time. So like even now in this Russia-Ukraine crisis and previously COVID-19, well, we are still in the pandemic. You have investors who have probably sold out some good investment. And years to come, the investors will not be in these positions, and then these stocks will be returning 10, 20, 30% per year. So the big question is, what do you do if you want to be a great investor and you don't have the right temperament? So if you can keep your emotions in check, you don't have to worry too much, because guess what? There's an investing strategy that has risen in popularity over the decades, and this is investing in ETFs and index funds. So this is a pretty much passive investing approach where the investor invests in ETFs on a monthly basis, and they are not necessarily trying to time the market. So essentially the investor would be investing in one stock that is well diversified. So this ETF would contain a bunch of other stocks, and it can be sector specific or it can be a wide market like a total stock market ETF. And you also have very popular ones that track the S&P 500. And most of the time when you hear individual talks about market returns, they are making comparison to the S&P 500. So all the investor would need to do with this passive investing approach is invest in a low cost ETF, show up every month, and dollar cost average every year, and dollar cost average, and do this for decades. So what this does is that it takes the emotion out of investing. You're not necessarily trying to time the market any at all, and you're not trying to time when you should sell your investment. So whether the market is up, you're buying, it's down, you're investing. And this is one excellent way to build wealth, especially if you're a busy person and don't have the time to analyze the market. And over time, you'll gradually get the market returns. And this is the investing approach recommended by Warren Buffett for most investors.
So this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. Just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war, and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
And this is why Warren Buffett loves to recommend this strategy so much, because guess what? It takes out all of the thinking and the psychology out of investing. You don't have to be worrying and panicking about if you should be selling or you should be buying. You just take your time, show up, and dollar cost average each and every month. And you will still get excellent results once you give it time. And time is one of the second most important thing you have to consider in investing. You have to give your money time to compound to reap the benefits. It's better to spend time in the market than trying to time the market, and you will hear the saying over and over, because guess what? You don't know when the market is at the top, or you don't know when it is at the rock bottom. And again, in times of uncertainty like this, the Russia versus Ukraine and the whole COVID-19 situation, just have to keep a cool temperament and just keep on dollar cost average. This is not the first war. There will be more to come. COVID-19 isn't the first virus, and there will be more to come. So you just have to prepare for these things in your investing journey and keep a cool head. So you're going to have some time when the market doesn't necessarily do much. It might be flat, but once you stay the course on dollar cost average, you will start benefit again once the market start going up. And here's Warren Buffett again talking specifically to this point.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Now, dollar cost averaging is a great way to go, because it protects you from your emotion and it protects you from wide market swings. Now, let's say you just started investing, right? And you have $10,000 and you went ahead and invest that $10,000 all at once. And before you know it, the market crashed down 40%. Would you be able to look at that 40% loss? While on the other hand, if you take your time and invest $1,000, it falls, then you invest another $1,000, it falls some more, then you invest another $1,000. That would be easier to manage psychologically. I believe Warren Buffett likes to recommend this strategy over his own, because a lot of individuals might be working, they don't necessarily have the time to analyze market or do any form of research, or they just want to invest their money and don't bother with keeping up with the stocks and how they are doing or anything like that. And he has held this opinion for a very long time too. This is an extract from a 1996 letter to his shareholders, where he said, most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to be the net results after fees and expenses delivered by the great majority of investment professionals. And this is so true, because there are a lot of research done out there to prove this fact. Would you even believe that a wealthy person like LeBron James, Warren Buffett even recommend that he invest in ETFs?
My first question would be, what should I invest in next? Can I have some tips?
I think somebody like LeBron, and we've talked about it, but I think...
You and LeBron have talked about it?
Occasionally. I think actually if through the rest of his career and beyond in terms of earning power then, just making monthly investments in a low-cost index fund makes a lot of sense. I think that somebody in his position ought to have a significant cash reserve and whatever makes them comfortable. And then beyond that, owning a piece of America, a diversified piece, bought over time, held for 30 or 40 years, it's bound to do well. And the income will go up over the years, and there's really nothing to worry about.
And if you plan to take the route of passive investing, you can literally schedule your investments to have it run on autopilot. So each and every month, if you plan to invest $500, then that can be automatically done on a schedule. You don't have to go in your brokerage account and make the purchase. And a great book on passive investing in index fund and ETFs is Money Master the Game by Tony Robbins. It won't necessarily tell you any form of ETFs to invest in, but it will give you some fundamental principles as to why it is important to invest early and why it is important to invest in index fund. And guys, if you don't want to buy the actual books or you can't find the books them to buy, you can always check out Audible, and that is pretty much what I use to listen to audio books, and I always utilize any freeness I get, and you can get 2 free books with Audible, and you can get a month free trial. I'll leave a link to that in the description below. Make sure you capitalize on whatever is free and enjoy it while it lasts. So that's it for now, guys. Thank you for watching. See you in the next video.